Good morning to you. Welcome to the 11th lecture in your business economics course. This week we're going to look at employment and unemployment, and then we will turn our attention to what seems to be an unrelated topic, inflation. But as we will see, inflation and unemployment are very much related to one another. Let me start with the slides a little bit earlier this time, and let's have a look at the PowerPoints to our topic for the week. Unemployment is the number of people of working age who are able and available for work at current wage rates, but who do not at the moment have a job. Government statistics class people as unemployed if they are of working age, which means they've left school, but they're not yet at the retirement age of the country, able and willing to work, but don't have a job. All these people who are of working age and wanting to work, whether they're currently in a job or not, are called the labor force. So the unemployment rate is therefore given by the number of unemployed divided by the labor force times 100%. One weakness of this measure is that people who do not want to work can call themselves unemployed, and some people who work have actually left the labor force in that they have given up trying to get a job after searching unsuccessfully. In advanced economies, most people who lose their jobs find a new job fairly quickly. But at any given time, most unemployment is amongst people who have been out of work for a long time. The implications for government policy are that efforts to reduce unemployment should concentrate on the long-term unemployed. The unemployment rate, by the way, is never zero. There are always some people unemployed, even when the economy is booming. We distinguish, as it says on the slide, between structural unemployment and frictional unemployment. Structural unemployment rises when more people are looking for jobs than there are jobs available, and frictional unemployment results because it takes time for workers to find the right job. Okay, the job that best suits their tastes and skills. And some frictional unemployment is inevitable because the demand for labor changes between firms and industries. For example, consider what happens when consumers start buying less goods from company A and switching instead to goods made by company B. Now, after some time, some workers at company A will likely lose their jobs, but new jobs might be created at company B. But it's going to take some time for the newly unemployed workers from A to move to company B. And this temporary unemployment is an example of frictional unemployment. Because the economy is always changing, this is happening all the time, with workers in declining industries looking for new jobs and firms in growing industries looking for new workers. And this, of course, has implications for government programs that exist to try to reduce the time that people are between jobs. Government-run employment agencies give out information on job vacancies and help match job seekers with job opportunities. And mostly this helps the short-term unemployed. Public training programs exist to reskill workers for new job opportunities. They're more geared to help the longer-term, structurally unemployed people. Economists are not always in favor of such government programs. Many argue that the free market would do a better job of matching workers with opportunities. Unemployment insurance. Now, it's not necessarily insurance as we know the term. We use the term unemployment insurance to refer to government programs that partially protect workers' incomes when they lose their jobs. These are common in advanced countries. Because unemployment insurance, it reduces the hardship resulting from unemployment. It also increases the length of the time that people are unemployed, as workers are under less pressure to accept the first job offer that comes along. On the other hand, research has shown that even though unemployment insurance increases the duration, the length of time that people are unemployed, it also increases the duration of the employment that follows. This may be due to the fact that when workers turn down unattractive job offers, they have the opportunity to look for jobs that better match their tastes and skills. Now, the next couple of slides, we look at minimum wage laws and minimum wage unemployment. Now, the market for labour looks like any other market. So let's consider this in relation to structural unemployment. The unemployment that arises when more people are looking for jobs than there are jobs available. And there are three possible causes of structural unemployment: minimum wage laws, trade unions, and efficiency wages. As we said before, the market for labour looks like any other market. It has a downward sloping demand curve and an upward sloping supply curve. An equilibrium price, which is the wage, and an equilibrium quantity of labour hired. Most workers in any economy earn a wage that is higher than the minimum wage, so they're not directly affected when governments introduce a minimum wage. Minimum wage laws mainly affect workers with lower skills or less experience. And on slide 6, we can look at this. Slide 6 shows that at any time the wage is kept above the equilibrium wage for any reason, the result will be a surplus supply of labour, which is what we call unemployment. Minimum wage laws are one such reason, therefore, for structural unemployment. Note the difference from frictional unemployment, where the main cause is the search for the right job. Sorry, I forgot to show you slide 6, didn't I? Now, here we can see that whenever the wage is kept above the equilibrium wage for whatever reason, the result will be a surplus supply of labour. The green box there shows what is happening, okay? So you can see that there is a legally binding minimum wage, which is higher than the equilibrium. That's the horizontal blue line. At that level, the demand for labour is less than the supply of labour. Okay, let's turn now to trade unions. The proportion of the workforce, there's some background here, the proportion of the workforce that is unionised, i.e. members of a trade union, is falling in advanced economies. In the UK, it was over 50% in 1980, 32.4% in 1995, and 28.4% in 2010, and it had fallen to 23% by 2019. Germany had a similar figure, but lower levels. 1999, it was 25.3, and by 2010, it had fallen to 18.6. The very last figures I could find, 2018, 18.5% of the workforce were in trade unions. The American figures are lower, 21% in 83, down to 10.3 in 2019, whereas in Scandinavia, they're much higher. 2016 figures were 52% unionized in Norway, 65 in Finland, 66 in Sweden. and 67% in Denmark. The process by which unions and firms agree on wages and conditions of employment is called collective bargaining. The unions try to get higher pay, better benefits, and better working conditions than the firms would offer if there was no union. And on balance, they're successful. Studies make it clear that unionized workers earn more than similar workers who are not members of a trade union. The implication of these results is that unions raise wages above the equilibrium level, therefore resulting in unemployment. The supply of workers to non-union companies will therefore increase, pushing down wages in these companies. Now, are trade unions good or bad for the economy? And the answer is, as you might expect, not a simple one. Critics describe unions as a cartel leading to higher wages, which is good for those with a job, but therefore fewer workers being hired, which is not good if you are one of those without work. Apart from the wage question, unions certainly caused problems for British industry in the 1970s, with their willingness to disrupt production by going on strike without warning. Of course, the other side of this argument would point to incompetent and aggressive management on the one hand, or weak management allowing itself to be bullied on the other hand. Union supporters, on the other hand, argue that unions are necessary to protect workers from overpowerful employers. And it has been persuasively argued that responsible unions who are willing to cooperate with fair employers helped German industry to flourish post-1955, as Germany was recovering from the results of the Second World War. Our third reason for unemployment, we have the theory of efficiency wages. According to this theory, firms might operate more efficiently if wages are kept above the equilibrium level. In other words, it might be profitable for them to keep wages high, even if there were a surplus of labor. There are four aspects to this theory. One is worker turnover. Firms can reduce labor turnover by paying higher wages than the workers are likely to be offered elsewhere. And that, of course, is especially helpful for workers with high hiring or training costs. Then we have worker effort. If a firm pays workers more than they could earn elsewhere, it's argued that they are likely to protect their jobs by working harder. And that's especially helpful for firms that find it hard to monitor the effort being put in by their workers. The third point is worker quality. Offering higher wages is likely to attract a better quality of applicants for new jobs. And this is especially helpful for firms who find it difficult to assess the quality of applicants. And fourthly, worker health. Better paid workers can afford to live healthily and also afford better health care. This is probably not important in advanced economies with healthy populations, but it can certainly raise the productivity of workers in less developed countries, where poor health is more common. Okay, now let's leave the topic of unemployment, but we'll come back to it and move on to today's second topic, inflation. Let's look at what it is, why it occurs, why it matters, and then how it's linked to unemployment. In advanced economies, most prices tend to rise over time. This increase in the overall level of prices is called inflation. Note that we're talking about the average level of prices in the economy, not the prices of all goods. In the last 30 years, UK inflation has been around 2 to 2.5%, varying in fact from 0.37% in 2015 to 3.86% in 2011. And previously, in 1975, for example, it had been 24.2%. Historically, in fact, also not that long ago, there have been examples in the world of hyperinflation. In Germany in 1923, the price of a loaf of bread jumped from 250 marks in January 1923, remember, to 200 trillion. That's 2 with 15, something like that. So it goes million to billion to trillion. By the November of 1923. So in a period of 11 months, 250 marks to 200 trillion marks. The more recent one that's been in the news, I guess, in 2009 in Zimbabwe, the government announced that inflation in the 6 months earlier, in June 2008, had reached 231 million%. So a loaf of bread, which cost $1 Zimbabwe in June 2007, would cost 2.31 million Zimbabwe dollars by June 2008. Everybody was a billionaire. Unskilled workers were earning $200 billion per month, which, by the way, was worth about 10 US dollars. The classical theory of inflation, so-called because it dates back to David Hume and other 18th century economists, explores the link between the money supply and inflation. And most economists today would accept this theory as the best explanation of what determines the price level and the inflation rate in the long run. Also explains both moderate price rises and hyperinflation, as in the Zimbabwe example that I just gave you. Okay, let's look at the level of prices and the value of money. When the price level rises, people have to pay more for goods and services, so that each euro that they have now buys less goods. So we can say that the value of money is lower. So if P is the price level, then the quantity of goods and services that can be bought with €1 equals 1 over P. So in other words, the value of money is the reciprocal of the price level. Note that if the increase in the price level is matched by the increase in incomes, then real incomes have not changed. So the next two slides, slides 12 and 13, we'll look at the money supply, the demand for money, and monetary equilibrium. The value of money is determined by the supply and demand for money, as in many other markets that we've seen. In a model that we're going to look at, we're going to ignore the banking system and assume that the money supply is fixed by the central bank. So it does not change unless the bank decides to change it. Therefore, the money supply is perfectly inelastic, the money supply curve being a vertical line at the quantity of money which is fixed by the bank. Therefore, the equilibrium value of money is determined by the demand for money. Now, in case you think surely the demand for money is unlimited, remember that money earns no interest. So rational people who hold more money than they need for buying things will convert some of the money to interest-bearing assets, so fixed savings accounts where you can't get at the money buying government bonds. So what we're talking about here is the demand for the quantity of money needed for transactions, which is the economist's word for buying things. And it follows from this logic that the demand for money is determined to a large extent by the price level. A higher price level, hence lower value of money, leads to a higher quantity of money demanded, So the demand curve for money slopes downwards, and slide 13 shows that's exactly what's happening. So there it's graphed for you. We show the value of money, which remember is 1 over P, on the y-axis, and its reciprocal, the price level, is shown on the right-hand side, vertical axis, inverted. So price level 1 at the top and price level 4 at the bottom. And the quantity of money is down on the x-axis. So the supply curve is fixed, excuse me, at the quantity decided by the central bank policy. And in the long run, the overall price level must therefore adjust to bring the money supply and the money demanded into balance. Because if the price level is above the equilibrium level, people and businesses will want to hold more money than the central bank has created. So the price level must fall to balance supply and demand. Whereas if the price level were below the equilibrium level, then people and businesses would want to hold less money than the central bank has created, and the price level will rise to balance supply and demand. What happens if we have an injection of money? That is to say, more money is created. Starting with the economy in equilibrium, then, what will happen if the central bank suddenly increases the supply of money, shifting the MS curve to the right? Clearly, the equilibrium value of money will fall, and hence the price level rise. I'll just quickly have a look at the next slide to show you what's happening. So MS1, the money supply 1, at the economy in balance, in equilibrium at point A, and then when it shifted to the right, to the red vertical line, MS2, you can see that the equilibrium point where the supply crosses demand has fallen to the position at B. The quantity theory of money states that the quantity of money available, what I've been calling the money supply, determines the price level, and that the growth rate in the quantity of money determines the inflation rate. Back to number 15. So what happens when the shift in the money supply goes from MS1 to MS2? Well, instantly we have an excess supply of money, and which people try to get rid of in a number of ways. One, they may buy more goods and services. Two, they may lend the money that they don't want to hold via banks or even directly to others who will also use the money to buy goods and services. So in either case, the increase in the money supply has led to an increase in the demand for goods and services. But because the supply of goods and services has not changed, then the increase in demand will result in higher prices, shown in the diagram as a fall in the value of money. Inflation has costs. The major problem is not the reduction in purchasing power of incomes, because incomes also tend to rise as prices rise. Remember that for every higher price a consumer pays, a seller has received an equivalent increase in income. And this feeds through into higher wages to workers to compensate for increases in the cost of living. But inflation does come with real costs. And we give them sometimes strange names. We have shoe leather costs. These are the resources wasted when inflation encourages people to reduce their money holdings, because inflation reduces the value of money held. And this involves a transaction cost, the time and convenience through more trips to the bank. Shoe leather costs can be very high, the higher the level of inflation. And we have menu costs, the cost of changing prices during periods of inflation, businesses have to change their prices more often. So imagine the effect on a small restaurant that has to print new menus every couple of weeks or so. Have in the next slide the misallocation of resources. Inflation tends to cause relative prices to vary more than usually. So consumer decisions are distorted, leading to markets not being able to allocate resources to their best uses. And we end up with, very often, with a reduction in funds for investment and future growth. Inflation discourages the saving that provides the resources for investment. And then confusion. The falling value of money makes it harder to measure important variables like income and profit. And finally, we have an arbitrary redistribution of wealth. And this is especially relevant when inflation is very high or unexpected. Imagine you take out a 30,000 euro loan to finance your studies. That would be about 500 euros a month for the 5 years until you have your master's degree. Now, if you have to pay 5% per annum interest, then you'll end up paying 38,300 euros or so. But if inflation were running at 20% per annum, then that 38,000 would only be worth 15,000 in today's money. Great for you, bad for the uncle who lent you the money. Now let's go back to what we said we would try and do, try and find a link between unemployment and inflation. On slide 18 now, we can look at the long run. And it makes it clear that in the long run, there is no direct relationship. They are independent of one another. The natural rate of unemployment depends only on various factors in the labour market, and inflation is directly related to the growth in the money supply, which is controlled by the central bank. However, the next 3 slides look at inflation and unemployment in the short run. And all economists now accept that in the short run, there is a trade-off between inflation and unemployment. So let's try and summarize what happens to bring about the short-run trade-off. Policymakers use monetary or fiscal policies to increase aggregate demand, say, for example, because they're trying to reduce unemployment. So the aggregate demand curve shifts along the aggregate supply curve, increasing output and therefore lowering unemployment, but at the cost of higher inflation. You can see this happening, and move quickly to slide 21. Okay, on the left-hand side, aggregate demand has been pushed to the right, therefore moving along the short-run aggregate supply curve. That's led to an increase in the price level, which of course is inflation. At this stage, don't worry about what monetary or fiscal policies are, as you'll learn all about them in next week's lecture, in lecture 12. If policymakers contract the economy, so reducing aggregate demand, then the aggregate demand curve will move left, reducing inflation, but at the cost of higher unemployment. And this short-run trade-off is known as the Phillips curve, which we can see in the wrong direction. Sorry about that. Go back down again to today. Okay, the Phillips curve, back on slide 20 now. Where does this come from? Well, in 1958, a New Zealand economist who was working at the London School of Economics published data showing a negative correlation between the rate of unemployment and the rate of inflation for the United Kingdom economy from 1861 to 1857. So we're just basically empirical, collecting data for inflation and for unemployment rate. A couple of years later, in 1960, two American economists, Samuelson and Soloff, showed a similar negative correlation for US data. And they argued that low unemployment was associated with high aggregate demand, which puts upward pressure on wages and prices. And so from this, they suggested that policymakers had a choice of possible outcomes, that they could use monetary and fiscal policies to choose any position on the Phillips curve, i.e. choose the combination of inflation and unemployment that they wished. Back to 21 again. If you look carefully, you can see how the movement from equilibrium point A to equilibrium point B on the price level versus output graph, which is the one on the left-hand side, that would generate a Phillips curve trade-off if you graph inflation against unemployment on the right-hand side. What about the long run? And Milton Friedman, a very famous monetarist, economist, Friedman and Phelps argued that monetary policy can only choose between inflation and unemployment in the short term, because in the long run, monetary growth does not affect real levels of output, so it doesn't affect unemployment. Therefore, in the long run, there is no trade-off. An increase in aggregate demand can only affect the price level, not unemployment, because the aggregate supply curve and the Phillips curve are both vertical at the natural level of output, the so-called long-run aggregate supply curve. What about expected inflation and the short-run Phillips curve? Friedman and Phelps suggested in 1968 that the higher the expected rate of inflation, the greater the inflation-unemployment trade-off, as the Phillips curve will be shifted to the right. You look carefully at the diagram. Let's look at what's happening. At point A, inflation and expected inflation are both low. Expansionary policies now move the economy to B, where inflation has risen, but people haven't yet got used to that. In the long run, people get used to the higher rate of inflation. It becomes expected. So the short-run Phillips curve shifts to the right, and the economy moves to C. And unemployment has returned to its natural rate. And then we have what we call supply shocks. These are events that directly alter firms' costs of production and hence the prices they charge, resulting in a shift in the economy's aggregate supply curve and the Phillips curve. In the 1970s, the most famous example perhaps, in the 1970s, the price of oil almost doubled within a few years, leading to a large shift left of the aggregate supply curve, reducing output and increasing the price level. So what we had, what we called, became known as stagflation. So a stagnant and non-growing economy with rising price levels, inflation. And the slide shows that plotting the move from point A to point B on an inflation unemployment graph means shifting the short-run Phillips curve to the right. Giving policymakers a less favorable set of inflation unemployment trade-offs. Because here, increasing aggregate demand to fight unemployment will raise inflation even further. And of course, the opposite also applies. So then economists started talking about the cost of reducing inflation. So let's say the central bank contracts the money supply to reduce inflation, aggregate demand falls, and the economy moves from point A along the short-run Phillips curve to point B. So inflation has fallen, but we've had a large rise in unemployment. Over time, inflation expectations will shift downwards, and the short-run Phillips curve will gradually shift back to the left. So the economy can reach point C, and unemployment is back at its natural rate, but the cost of reducing inflation was an extended period of high unemployment, moving from A to B to C. Where some economists argued, and that was being called the sacrifice ratio, the number of percentage points of annual output lost in the process of reducing inflation by 1 percentage point. Some economists started to talk about a theory of rational expectations, suggesting that when rational people are considering the future, they will make the best possible use of all of the information that they have, including information about government policies. Now, if this were true, then when government policies change, people will change their expectations about inflation. So if the government makes a credible commitment to reduce inflation, people will lower their inflation expectations immediately. Now, if that happened, look quickly back again at slide 25, then the short-run Phillips curve would move more rapidly to the left, and inflation could fall without the extended period of high unemployment. So the triangle ABC will get a lot smaller. Okay, let's finish with some conclusions on the inflation debate. Primary cause of inflation is the growth in the money supply. To maintain stable prices, the central bank therefore has to maintain strict control over the supply of money in the economy. There are costs to inflation, especially hyperinflation. There is a temporary trade-off between inflation and employment. That's what the Phillips curve shows us, but there is no permanent trade-off. And the temporary trade-off really comes from unexpected inflation, which usually means when the rate of inflation is rising. And a rising rate of inflation may reduce unemployment, but a high rate per se will not. There we have it, the end of lecture 11. And next week, I'll try and explain to you exactly what we mean when we talk about monetary policies and fiscal policies by the government to affect the economy and what's happening in the economy. Thank you.